Welcome back. You're still watching World Insight with me, Tian Wei. The program is coming to you on CGTN from Beijing. Now let's talk about China-U.S. trade. Uncertainty lies ahead for Chinese companies such as Huawei and many others in the American market. American producers and consumers agree that they too will be hurt by added tariffs, and global economic growth is at stake if the world's two largest economies don't get along. Both sides say they want what's fair, but a deal has yet to be reached. How will all parties cope if trade tensions keep escalating? And what about the fate for investors busy between China and the United States? Before we go to our panelists today, take a look at this first.
Beijing and Washington are in a stalemate in the month-long trade war. On Tuesday, the Chinese Ministry of Culture and Tourism issued a warning to its citizens to exercise caution before visiting the U.S. The alert comes after the most recent wave of mass shootings in the U.S. For months, China has tried to avoid a trade war that could hurt the global economy. On Sunday, the Chinese government issued a white paper on trade frictions with the United States.
The white paper stresses the economic and trade friction provoked by the U.S. damaged the interest of both countries and the wider world. The U.S. imposed tariffs harm others and are of no benefits to the U.S. itself, impeding two-way trade and undermining market confidence and economic stability. The trade war does not make America great again.
On Monday, the U.S.-based Institute of Electrical and Electronics Engineers reversed restrictions on employees of Huawei and its affiliates to edit and peer review IEEE's research papers. The previous restrictive approach triggered extensive criticism from the international research community.
For more on U.S.-China trade war, we are joined in our Beijing studio by Professor Liu Baocheng, the Dean of the Center for International Business Ethics from the University of International Business and Economics. Also in our Beijing studio, Ben Harburg, investor and also member of the Board of Directors from the National Committee on U.S.-China Relations. And in Hong Kong, we are joined by Xiao Geng, a professor at Peking University HSBC Business School. Welcome to the three of you, gentlemen. How long should we expect this protracted trade war to continue? Ben, to you, an investor.
We're really bearing down for the long term here. I think, unfortunately, because of these decoupling actions that have taken, in many instances, trust has been broken, and different sides are now trying to essentially balkanize supply chains, balkanize capital markets. And I think the ramifications will last for decades, if not indefinitely, because we can't simply just put these things back together, even if a trade deal is quickly reached between the two sides. And so China will seek alternative sources of key inputs, and the U.S. will do the same.
Professor Xiao, is Mr. Harburg too pessimistic?
If the U.S. economy suffers a serious recession, I think President Trump will reconsider his positions.
But how big is that possibility?
Well, I think now the market and also a lot of people realize that the U.S. economy is disrupted seriously by this trade frictions, and a lot of profitability and other serious issues is going to coming more and more.
We see some stock market reactions recently, Professor Liu. For example, when President Trump was talking about 5% tariffs on Mexico, which is part of the, of course, very important North America Free Trade Agreement, now coming to the next stage. And then we also see China trying to put out what they called so-called entity list, trying to put some of the foreign companies who cut up supply to the Chinese companies illegally, according to the Chinese side, onto those so-called lists. So what would happen to the stock market? Nobody knows, and it's supposed to be vulnerable anyway. But how much do you expect these things to continue, given the political cycle?
Well, we do not really see quite much of a deter because at this moment, each side is really stepping up their weapons for injury. So unless each side feels the real pain, and then there is a backfire in the backyard, they won't really stop.
So, Mr. Harburg, which means you guys are going to suffer because you're going to put real money, real investment into various projects on both sides. So you are sucking in all the losses as a result, the business communities from both sides. Is that?
I mean, investors like my firm are probably pretty well buffered against this situation. So most of our investments are focused on China, Chinese consumer internet. Our companies aren't relying on U.S. imports, so chips, operating systems. We're looking at Chinese domestic consumption stories and then kind of ex-China emerging market technologies. And those stories are strong even in this situation.
But on the other hand, you are cutting back your expectations about cross-border investment. What I'm saying is between China and the United States. Is that what you're trying to indicate?
Well, our firm had already stopped doing that about 2 years ago
Yes.
on the basis that we thought returns in China and emerging markets were stronger. But I think if you're someone today who's trying to use Chinese state-owned capital to invest in the United States or investing cross-border, it's going to be a pretty difficult stretch.
But on the other hand, Mr. Harburg, if I could challenge you a little bit, because many of the investment and projects that you're doing here in China, and for the other investors as well, are pretty much an entity behind which there's an international team, particularly about innovation and the application of innovation. So when you have a real decoupling situation between the two economies, two driving forces of the world economy, what kind of reality are we really thinking about right now? Are you prepared for that?
No, I think certainly one of the four kind of core areas of decoupling that we're worried about is the innovation decoupling. And historically, the innovation pendulum has swung back and forth between the two countries, and one will innovate and the other will kind of iterate on that design and then build something new, and then the other one will copy, and it goes back and forth. And we're actually in a place where a lot of the consumer internet models pioneered in China are now being replicated in the United States. And so I think decoupling that innovation on both sides will be difficult for both sides ultimately.
Over the past few weeks, stories coming from major Chinese companies, major Chinese global companies. They talked about attempted or already withdrawing from being listed in the New York Stock Exchange, for example. And they talk about going back to China, the Greater China, and be listed in some of the major stock markets here. How do you see this trend? Is this another step of decoupling as a result of the recent realities for the Chinese companies?
This would be a trend. A lot of Chinese companies listed in the U.S. now they discover that there are serious problems. So they are moving back to Hong Kong, and here the investors are much more familiar because their business are mainly in China. So this will help to decouple the two big economies. And the Chinese economy is much bigger in terms of number of investors. So if you look at the long term, this will be a trend. The market will move back to China.
Well, Mr. Harburg, of course, there was already earlier discussion about this. Chinese economic and trade system has already growing in such a way that it is, to a certain extent, different from so-called Western style. And the American way, of course, is not going to change as a result of the existence of China's system. So there is already quite some differences between the two, and therefore, this earlier or later, this is going to be the case anyway. Some say that. Do you agree?
I don't necessarily agree. I think actually we have very synergistic systems. In some instances, perhaps Americans can produce chips or IP that can be harnessed by technologies that the Chinese then commercialize, and those are able to be sold into emerging markets, kind of to target the next billion consumers,
right,
in a way that American kind of front-end companies might not have been able to do. And so, there are about 52,000 jobs today in America tied to producing technologies for China. Most of the chip companies today in America, 30 to 50% of their exports are into China. These two markets actually work together very well. There's a demand and there's a supply on both sides of capital and products. And ultimately, I think we can work together to harness those technologies for kind of global expansion and addressing these next emerging markets. But in this kind of environment, we're seeing that decoupling and balkanization accelerated, unfortunately.
And a lot of Chinese companies, particularly those application of technology related or innovation companies, are actually listed in the United States or have dual listings for now. So if this trend continues, what does it mean for them?
I have to respectfully disagree with the other panelists. I think that, you know, the trend of companies delisting from the United States and going back to the A-share market or even Hong Kong had already started a few years ago. As he correctly identified, they came here because the investors here understand those business models more intimately. The multiples are higher in this market for many companies, and so it's an attractive proposition for them to delist. The one company that did that very recently, which was a chip company, was a very lowly traded business, not a lot of liquidity there, so I wouldn't say that that's kind of a harbinger for things to come. I still think that most Chinese businesses
But there is reporting about Alibaba, though, even though Alibaba did not react positively or negatively to that report.
Sure, but if you talk to Charles Lee, he'll tell you he's been trying to get Alibaba back for years after losing them because of the A-share, B-share debate and control over the company. So I'm not surprised by that move either. Companies still view the NASDAQ and the NYSE as the global exchanges, and if you want to be a global company, let alone one that targets America, you need to be listed in those exchanges.
How well equipped, Professor Liu, are the Chinese companies when they are still thinking about dealing with the United States market and continuously doing what they've been doing over the past 40 years with the so-called political sophistication and also the practical skills to be able to move swiftly once realities change, Professor Liu?
Companies are really responding with such a level of uncertainty with a number of scenarios. So either divesting or reallocating their business, and also get ready with price markups if the tariff is still being mounted up. So therefore, businesses are really very savvy. Actually, 2 weeks ago, I toured around in the United States. Actually, everyone, not only the Chinese companies who are dealing with the U.S., but U.S. companies dealing with China, are also preparing with a number of scenarios so that they can really respond in a more positive or preemptive fashion.
How much do you think the business should be prepared? To what extent can they really be prepared, given as big a scenario as we talked about earlier, Professor?
Well, yes, the decoupling is actually increasing cost of, and maybe for a very long time. So the companies, they have to prepare for that by basically looking at alternatives, and this is the reason that I think the Chinese market, particularly the Hong Kong market, will be used more often because the U.S. market now is become like not reliable because the influence is so much by politics. And that's the #1 uncertainty companies don't like.
You can't imagine what are the alternatives that would replace the United States for China, or replace China for the United States when it comes to trade and economic ties for the near term, so that the two economies could still grow with the momentum. Mr. Harburg.
Yeah, I think it's going to be it is impossible, right? I mean, we can describe a world where China kind of isolates itself technologically, builds its own operating systems, chips. I don't know what the timeline is for that being achieved, but it could happen. But ultimately, everyone is damaged in that scenario. The American companies that produce the core technologies, that harness the IP, they're losing the commercialization of those technologies and the global scaling. Likewise, the Chinese are losing access to the technology. And so, as I said, they're very synergistic markets, and the damages here are ultimately going to be felt on both sides. And I think we can walk back from this edge. I really feel like we're right now being held hostage by a group of individuals who are using tariffs as a ploy, essentially, to get what they want in a system where they can't necessarily dictate things on a legislative process or with an interagency working group. And so that's why we see things like the Mexico 5% trade tariff coming into play and what is essentially an immigration and safety issue. I think they've just kind of come to the point where they think this is the only thing they can use to get things done in a relatively inefficient way.
But on the other hand, you also heard different voices accusing the American business community, for example, Jeffrey Sachs, talking about it's not necessarily China's problem, but rather the greed of American international companies that have been creating the so-called trade deficit and also the trade issues between China and the United States. What do you think, Mr. Harbour, as a member of the American business community yourself?
Listen, I think that's the trade deficit, as many people have already dismissed, is not really the metric of success of an economy, right? So I don't think it's fair to use it. I don't think it's due to American greed. I think American companies evolved in the way that they could based on the strength in the Chinese market and low-cost manufacturing, the American ability to generate and harness IP. So in the long term, I think this was a good fit for both markets, and the result was going to be a trade deficit, but that's not the reason to initiate tariffs.
What do you make of that, Professor Liu, of the earlier fact that pointed out by Mr. Harbour that some of the domestic issues and conflicts are being externalized in a way by Washington finger-pointing others, say, see, you didn't do this, and therefore that's where we are. Professor?
Yeah, so to find a scapegoat is really the conventional technique of any politician if they are really not acting in a responsible fashion towards their own nation. And that also can at least temporarily cover their inability to navigate the economic growth course. So now, with time, people are really getting more and more aware that what type of games he's playing. For example, I'm going to win and China is going to pay, or Mexicans are going to pay, but in the end it is really the American businesses, American consumers are going to pay, but the federal government is going to enrich its coffer because tariff goes directly to its pocket at his disposal.
Of course, they could also give subsidies to the farmers, but whether that's sustainable
But then
practice,
he can really curry favor with the farmers, with the dollars paid by every American consumers.
There we go. So it's a very simple matter, actually, if you think about it. Professor Xiao, what do you think about the debate that we're having right here, the nature of things?
China market and the Asia market is really so big. And the companies, the multinational companies, they already are here. So basically, they will tend to cut, the relations with the U.S. So it's really bad for the U.S. I would say. It's the U.S. trying to isolate China, but in the end, it's going to isolate itself.
So what do you
because
think,
the
Professor?
investors, they are smart.
Okay, several things, different layers. The negotiation is a negotiation, so everybody's going to play hardball, white face, red face, whatever. And that is a tactic of a negotiation. There's another layer, which is about the real nature of the relationship between China and the United States. That is much more important than the earlier that we're talking about. And there is, further than that, another layer, which is what does the two economies relationship mean for the rest of the world? And even the world order since the Second World War.
Well, I think a lot of people want to kind of frame this relationship, and they want to call it something like strategic competitors, right? Or one of these kind of terms that, and that's the debate.
To you?
I call it, I don't know what. I think
there we go.
I try to stay away from these kind of labels, but that's a lot of the debate centers around that. How do we term China? Are they a partner? Are they a collaborator? Are they a competitor? Are they an enemy? I don't think it's as nuanced as that. It's not black and white. I think we can collaborate on all kinds of things like climate control and whatever else, but we also compete for market share, and we compete in research and development, right?
And therefore, leadership is extremely important at this critical juncture. Professor Xiao, briefly from you, your thoughts about the rather philosophical question that we talked about earlier.
Well, I think China and the United States each need each other, very much, and basically they are competing with each other. And I actually, in the longer term, I'm still optimistic. The two countries are just so much need each other.
Professor Liu, what do you think? Final words.
Well, it's still, I think now the current impasse can really be positively understood as a time for leaders to really reflect on what is exactly the end goal. Are they really serving their people? Are they really serving the humanity? Because they are the leaders of the two biggest economies. And then what would be the road path for us to really work together so that we can isolate differences and find solutions towards those differences But in the meantime, we still have to work together.
Liu Baocheng, Xiao Geng, last but not least, Benjamin Harvard. What a pleasure to see the three of you in our program. Thank you so much, gentlemen, for your contribution. And that is all the time we have for today. If you'd like to see more, try to find us World Insight CGTN into your search engine, or check out our YouTube channel. You can also follow us on Twitter, Facebook, and Sina Weibo. From me, Tian Wei, and everyone on the World Insight team, thanks for watching. Tune in again next time for more insights across China and around the world.